You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Boot Camp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Options Bootcamp is brought to you by Tradier, a REST-based open and secure API for investors, advisors, and traders. Open a Tradier brokerage account and trade the way you want with competitive pricing and a unique API. Learn more at Tradier.com. And now, let's get you into peak options trading shape. It's time for Options Boot Camp.
Welcome back to Options Boot Camp, the program here on the old network where we break down the scary, the big, bad, and mean world of options into nice, easy to understand trades and strategies and tips and techniques that you can utilize in your own portfolio. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the Options Insider Radio Network. Pleased to have Options Boot Camp making its way back onto the rotation. We love it. We know you guys love it. We've been working on getting it back for you. Hopefully you guys are liking a little bit more frequent taste of a little bit of boot camp in your inbox. And joining me to help give you that taste, the master chef himself, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the show. How go things in your cooking as well as your trading, sir?
Oh, going pretty good. Either way, I'm whipping up some good stuff.
Well said, sir. Well played. All right, and Dan's going to help me whip up some answers to your questions with a little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call. I love the mail call. Every day is 4th of July when you're doing the mail call. You guys have been hitting us up week in, week out, month in, month out, even though boot camp hasn't been live in a while. So we appreciate your support. We appreciate your love. We mostly appreciate your patience. I've been trying to get your questions filtered out to other shows, so hopefully you tuned into those. But I know a lot of you may not have caught those, or maybe you dislike this show. Either way, we'll get you answered here too. Don't worry. A little patience is rewarded here. Let's kick things off. Robert Stout. He says, Mark, just a little bit about the options trade / strategies that I use. I trade the short put verticals and have been doing well, but I'm getting hammered on the max losses. I'm looking to get into, let me start that over. I'm looking to get into other strategies that have a better win-loss ratio. A friend mentioned your show, and he thought your show and your contacts would be helpful to me. Robert. Well, Robert, first off, welcome to the show. Glad you're listening. Glad you're liking. You're a new convert here to the boot camp. Glad you're listening. Yeah, this is a frequent issue. You know, there's a lot to unpack here. I wish you included maybe a little bit more details, what kind of underlying you're looking at, what your methodology is for where you're writing these short puts. I think that's going to account for maybe a lot of why you're having less than stellar performance on these. I mean, it depends. Are you finding an underlying that you really have a knowledge of and like, and you understand what's going on out there, you understand the volatility and the skew and the term structure, and you're choosing appropriate strikes based on the volatility scenario out there and the trading regime on the paper, or you may be doing some cursory scans on your broker and you're finding random underlyings that have a large amount of volatility on them and then looking to sell the volatility there. Because guess what? When names have a high volatility, sometimes, in fact, frequently, it's merited. The name's going to move. In which case, you're right. You're going to be hitting your max losses on those short put verticals very quickly. I do like that you're doing risk mitigated. You're not just selling short puts. Usually they get these emails, and I'm sure, Dan, you get these as well, and you people probably come to you with this question. Hey, I've been selling short puts, and I'm getting blown out. What can I do? So at least you've taken that first step, which is a good one, Robert, which is you're doing the verticals. People always say, why do you recommend verticals? Well, because of this stuff like this, because it can go bad, in which case the vertical's there to keep it from taking your house. You lose the $5, but you keep your house. That's a nice trade. So I'm glad you're doing that, but a little bit more data would be preferable. Dan, I'm sure you've had people come to you with questions like this all the time. Maybe you had one today. I don't even know. But he's doing one of the right things. He's using verticals rather than just blasting out puts. But he's getting hurt on it nonetheless. What would you counsel for him? What would you tell him to turn his trading attention to, perhaps in lieu of the short put vertical?
Yeah, I mean, the short put vertical is not a bad strategy. For the right thesis, it can be a great strategy. But like all trades, there's a couple of things that can go wrong. And some of the common things that go wrong are, you have a profit, maybe you sold the spread at $1 and now it's trading at like 35 cents offer. You can buy it back for 65% of your profit or something. So many people don't do that. They just let it go and say, I'm going to squeeze every penny out of this. And then that one unexpected day comes along and they go from 65% of their max profit to max loss. So take your profits. There's one thing. And then the other thing is take your losses. When it goes against you, like don't sit there and hope and, guess and wish that it would turn back around. Get out. They say the first loss is the best loss. Just cut your losses, keep them small, because the odds are on your side. You're selling small delta options, which means the chances of them, oversimplification, but expiring worthless, are in your favor. So, it's all about, it all comes down to management. And are you going to have those times every once in a while where like things are going okay, it's not time to take a profit, not time to take a loss, but it just gaps open, gaps lower? Yeah, you're going to have those times. Also, don't hold them going into earnings, and you can avoid those scenarios much of the time. But it's all about trade management.
Yes, so Robert, it's hard for us to give you concrete advice without knowing a little bit more about your methodology, how you're choosing your underlyings, how you're choosing your strikes. That could be 90% of the problem right there, but we kind of just laid out some ideas. You can always switch to even more risk-mitigated types of strategies like the spreads with wings, like flies or iron condors or things like that. But you're doing the verticals, you're doing risk-mitigated already. So I think maybe that's not your problem. Maybe it's really more of the strike selection or underlying selection. So give us a little more input on that, and maybe we could steer you in a more concrete direction. All right, next up here, Kevin Duggan. This actually seems like it's a recent one, Dan, because it's timely. It's SPY dividend time. And you know how I know that, Dan? Because inevitably, when the SPY dividend happens, we get questions like this. I don't even need to check my calendar. When I'm getting questions about what's going on with my calls in SPY, I know it's dividend time. You get the same feedback, Dan?
Yeah, it can lead to some questions.
Yeah, usually it's the opposite. Usually it's, hey, they write covered calls in SPY. They think it's a super safe thing. They forget that there's a dividend, and all of a sudden there's crazy, funky assignment and exercise happening around and they're like, "What's going on? And what my position's changed. I don't know why did this happen." That's usually the question that we get. This one looks like it's a little bit different, but a similar theme. This comes from Kevin Duggan. He says, SPY paid a dividend today and is now trading 67 cents lower this morning. But my SPY calls are actually 6 cents higher. I expected them to fall! ! Can you please help me understand why the calls are not down? Thanks. Well, there's a lot to unpack in this scenario. You're right. The basic math is there. You pay the dividend, the underlying should fall. But of course, there's a lot more baked into the options than just that. You have skew, you have a bunch of other factors that are at work, and sometimes they can obscure the little bit of the fog, the haze that obscures what's actually happening out there with these options. Dan, I'm sure you get these questions a lot. Maybe you got some recently around the recent SPY dividend. What do you have to say here for our buddy Mr. Duggan, who's like, why didn't my calls fall when the stock drops, sir?
Yeah, a lot of people don't think about it, but the option pricing model is a pretty darn clever thing. And what happens when stocks go X, have their X dates, is the stock, if the stock or ETF in this case opens unchanged, like not up or down for the day when you look at the net change on the day, it is lower by the amount of the dividend. So I know it sounds kind of confusing, but let's say there's a 50-cent dividend, right? And the stock is trading at 100. If it goes X, then when it opens in the next session, if it opens unchanged, like it says did not go up or down, it's exactly zero, it'll actually open at 99.50. So there's that. But see, here's the thing. The options pricing model knows this. It knows it's going to happen. And those dividends are already priced into the price of the options, because if I own the shares, I get the dividend. But if I own the calls, I don't get the dividend. So that's why, you see the underlying stock or ETF drop, but you don't see the call price change. So it's a little nuanced, and the more you understand these little tiny nuances, the better off you are. So I'm so glad that you're asking that question to sort of get that at least a little seedling of something to follow up on and learn a little bit more and be able to make more money trading.
Yeah, there's no free lunch at the end of the day when it comes to options. These dividends are not a mystery. The amount of it could be a little bit of unknown until the date, but the dividend's coming. People know that, so that's all baked in, particularly for a big liquid name like SPY. That's why these emails always come, because inevitably someone gets out there and they're not really certain about how the dividend should impact things. So yes, unfortunately there is no free lunch. And that's why you're selling names in these high dividend paying stocks. That's a downside to it, because it makes those covered calls. The premiums are not there because you don't own the stock, so you don't get the dividend, so the calls are not as attractive. So it's already kind of baked into that trade to begin with. You're getting less income to do it already. So effectively, when you sold that call, I'm assuming you sold it because you're sad it didn't go down more, you already kind of encountered some of that already. So in that sense, you already encountered that, unfortunately. But yes, the SPY dividend, it's a constant font of questions, which is why we like it here on the show. But remember, if you're trading SPY, it's not just a little silly passive index that goes up and down. There's a dividend to it. And particularly around that ex-div time, it causes all sorts of consternation, people writing covered calls and things. So pay attention to that when you're out there trading their SPYs. All right, here. Next up, we did Kevin. Barrett. Barrett Wade says, hey there. Well, hey back at you, Barrett. He says, do you guys have a rule of thumb to keep from overpaying for an option? Oh, wow. It's a very simple question, but that could fill quite a bit of time. Keep from overpaying. I've said this before. I think one of the basic tools a lot of people don't utilize enough, and it is a good way to kind of gauge where you are on the spectrum of underpaying or overpaying, are the volatility cones. What that is the tool that shows you effectively your base levels of volatility over some certain period. You can adjust the frame of reference. You can go back 6 months, a year, whatever you want. You can look at the actual volatility the underlying has exhibited. You can look at where the implied levels of volatility are in relation to that. And then you could see on a baseline in that cone, it'll show you, here's the average. Are you paying around the average level of implied volatility for this particular option? Are you paying above it, maybe one standard deviation above? It's kind of like a Bollinger Band, effectively, for volatility. If you're looking at yourself and saying, hey, I'm paying 2 standard deviations above this average level of volatility for this product here, you probably want to second guess that, and at the very least have some sort of short leg against it. I mean, it could be merited, it could be warranted, there could be things going on in the underlying that cause that volatility to increase, but you should at the very least be cognizant of that fact. And the same goes for the other side. If you're super, super low, then you probably at the very least should be cautious about selling it, and you probably might want to look into buying that. So that's the starting point. I want people to start there. There's a lot more to do. I'm sure, Dan, you have other things you do in addition to gauging the overall level of volatility against the historical. What else do you do when people come to you, guys like Barrett, and say, hey, how do I know if I'm paying too much for this freaking option, sir?
In my opinion, that's the only thing that you need to do is look at the volatility. There's nothing else. Like it is exactly that simple. How do you know if you're overpaying? You look at the implied volatility relative to itself over the past 6 months compared to today's historical volatility, and then look out a bit into the future and see if there's any things that might affect the volatility, causing it to go much higher, much lower in the future. Which we call it here at MarketTake our 1, 2, 3 volatility analysis. If you just do that one simple step that so many traders neglect, and that's why trading doesn't work for them sometimes. If you just do that one simple step, oh man, you are miles and miles ahead of the typical trader, and I believe it can make a profound difference in your trading.
Can indeed. It's a basic step. A lot of people don't do it. A lot of brokerage platforms don't bury that or don't offer it. So dig around, find a way to look at analyze the historical levels of volatility for your product and compare them to where you're trading right now. And that'll give you a good framework, a good barometer for where you fall. And then you can kind of intuit it from there, whether you're really overpaying or maybe perhaps you're getting a deal, in which case you should be excited. All right, next up comes from Boring. Even though his question really isn't that boring, his handle's kind of harsh. But he says, or perhaps she, you never know, when do you just buy a call versus a spread? Is that ever the preferable option? Yeah, sure. I mean, we like to counsel verticals for a variety of reasons. Usually verticals on the short side because it mitigates your risk, as our friend Robert has discovered, much to his chagrin, that the vertical is a lifesaver there. But on the long premium side too, we like verticals because it mitigates your outlay. That's the thing that paying money for an option is something a lot of people have a hard time doing. They can't wrap their heads around it. So mitigating that outlay, that's an easier way for them to get around it. But certainly there are times, usually when you're expecting some sort of big bang for your buck to happen in that underlying. Maybe you expect it to pop, a big move, so you want to have a big delta exposure. Maybe expecting the vol to explode as a result, so you want to get a lot of Vega bang for your buck. Either way, when you're buying premium outright, you really are expecting and looking for something big to happen. If it's just going to sit there and kind of drift around, you do not want to be out there buying premium outright because you're going to get decay and it's going to really hurt and it's going to be a death by 1,000 cuts. It can still kill you. It's just slower and more painful as a result rather than the one quick, bad, painful knife thrust of the short put. So there are good, legitimate times, but usually you want something that's going to merit it, which is something that's going to deliver you a lot of delta movement, a lot of volatility, maybe a combo of the both. That would be a best case scenario. Mr. Dan, when do you tell people they should buy a call versus a spread, sir?
Yeah, to me that one's an easy answer also that we share with our students all the time. Just think about it in terms of volatility. Like options are instruments of volatility. When you buy them, you're buying volatility in every sense of the word, implied volatility wise, but also you want a big move when you're outright long options. Spreads, you hedge off volatility. So there's less implied volatility risk and there's less exposure to a big move. If you have a vertical spread on, if you get a lot of volatility, it doesn't benefit you as much as if you didn't have the spread and you were just pure long options or pure long volatility. So, this can really help people in their strategy selection. When you're looking for a real big move, you just buy options. And when I say looking for, I mean, I'm not saying wanting. I'm saying your thesis is, hey, I think there's going to be a big move here. Then you just buy options. If you're expecting a more limited move, like up to a resistance or a support level or something like that, you're way better off with a debit spread because you're paying less, you're risking less, and you can potentially make even more because it's more suited for that smaller volatility move.
Yep, you got to have that expectation going in. Otherwise, stick with the risk mitigated, premium mitigated type strategies. But if you expect something to blow the doors off, and hey, go for it. We're not here to tell you no. We're just here to tell you to be cautious and judicious when using that approach. You know, Dan, I love the listeners of this show. They're so nice. They're so pleasant. Let's wrap it up with a couple easy, fun ones here. First off, we got Nitin Kumar Tyagi, who just wants to say hi. He says hi. Well, hello back to you there, Nitin. Thanks for the love. Keep listening. And let's wrap it up on this one. This is Momo Rob, another very pleasant listener here. He says, good morning. Well, good morning to you, wherever you are across the world there, Mr. or perhaps Mrs. I think the name's Maurice, so we're going to go with Mr. here. Good morning. I was wondering, do you give courses on how to trade options, or what kind of service do you have? Dan, sounds like yet another listener who may indeed be right up your alley. So why don't you tell Mr. Momo Rob and anybody else out there, if they're interested, maybe they want to get some courses on how to trade options, or indeed, as he puts it, what kind of service do you have, sir?
Yeah, I mean, first, I will just say I'm so glad you're asking that question. That's half the battle right there. Yeah, no, but I'm so glad you're asking that. I mean, that is what we do. You know, this is sort of my way of giving back to the trading community and helping people be successful. And so many people attempt trading by just sort of jumping in. You know, they watch 90 seconds of a 3-minute YouTube video and say, oh, well, this is what options are, and they dump some money into it and it doesn't work out, and they wonder why. You know, the people who make money trading, you know, they put in a little bit of time, and it doesn't have to be super time consuming to learn, but definitely seek out some education. We would love to be that person that helps you. You can surf on over to markettaker.com. There's a button on there for our free newsletter. You can get a trial of our subscription newsletter as well, and there's a whole bunch of resources there. So check it out. If you like what you see, we'd love to take it a step further with you.
All right. Unfortunately, that music means we come to the end of another fun mail call. We love you guys' questions. You're so nice. You're so polite. You have so many great questions. Thanks for listening. Thanks for writing in. Thanks for sticking with us. We're back here. We're back now. We're back in your lives. So you don't have to worry anymore. Your boot camp is back. We're here to answer your questions, to hold your hand through these scary, tumultuous market times using options. So keep listening. Thank you for listening. On behalf of Mr. Passarelli, Andy, D, myself, I want to thank all of you out there for downloading, streaming, and subscribing. Of course, we're sending in these very polite questions. Keep them coming. Hopefully, we're making a dent now so you guys can catch up on a fairly frequent basis. And we'll see you back here next time for more Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.